Good morning, friends. Today we are focused on principle of insurance. Lecture number 5. Myself, Dr. Deepak Vishwanath DOKHALE, Assistant Professor, Department of Commerce, KTHM College, Nasik. In our previous lecture, that time I was explained types of insurance, life insurance and general insurance. After that, we are discuss advantages of life insurance, types of life insurance and general insurance, and lastly difference between life insurance and general insurance. In our today's lecture, we are focused on principle of insurance. In this lecture, we are discuss principle of insurance, risk and insurance, and lastly types of risk. Okay, now we are focused on principle of insurance. The concept of insurance is risk distribution among a group of people, hence cooperation becomes the basic principle of insurance. To ensure the fairness and for the proper functioning of insurance contract, the insurer and the insured have to uphold the 7 principles of insurance mentioned below. Number first, principle of utmost good faith. Principle of utmost good faith. The very basic principle is that both parties is an insurance contract should act in good faith towards each other. That is, they must provide clear and concise information related to the term and condition of the contract. The insured should provide all information related to the subject matter, and the insurer must give clear detail regarding the contract. For example, Jacob took a health insurance policy. At the time of taking insurance, he was a smoker and failed to disclose this fact. Later he got cancer. In such a situation, the insurance company will not be liable to bear the financial burden as Jacob concealed important facts. Okay? Second, principle of proximate cause. This is also called the principle of cause proxima or the nearest cause. This principle applies when the loss is the result of 2 or more causes. The insurance company will find the nearest cause of loss to the property. If the proximate cause in the one in which the property is insured, when the company must pay compensation. If it is not a cause the property is insured against, when no payment will be made by the insured. For example, due to fire, a wall of building was damaged and the municipal authority ordered it to be demolished. While demolition, the adjoining building was damaged. The owner of the adjoining building claimed the loss under the fire policy. The court held that fire is the nearest cause of loss the adjoining building, and the claim is payable as the falling of the wall is an inevitable result of the fire. In the same example, the wall of the building damaged due to fire fell down due to storm before it could be repaired and damaged an adjoining building. The owner of the adjoining building claimed the loss under the fire policy. In this case, the fire was remote cause and storm was the proximate cause. Hence, the claim is not payable under fire policy. Okay. Number 3, principle of insurable interest. This principle says that the insurable means insured must have an insurable interest in the subject matter. Insurable interest means that the subject matter for which the individual a financial loss if there is any damage, destruction or loss. Example, the owner of vegetable cart has an insurable interest in the cart because he is earning money from it. However, if he sells the cart, he will no longer have an insurable interest in it. The claim, the amount of insurance the insured must the owner of the subject matter both at the time of entering the contract and at the time of the accident. Okay. Number 4, principle of indemnity. This principle says that insurable is done only for the coverage of the loss, hence insured should not make any profit from the insurance contract. In other words, the insured should be compensated the amount equal to the actual loss and not the amount exceeding the loss. The purpose of the indemnity principle is to set back to insured at the same financial property insurance and not applicable for the life insurance contract. Okay. For example, the owner of commercial building enters an insurance contract to recover the cost for any loss or damage in future. If the building sustains structural damages from fire, then the insurer will indemnify the owner for the cost to repair the building by way of reimbursing the owner of the exact amount spent on repair or by reconstructing the damaged areas using its own authorized contractors. Okay. After that, principle of subrogation. The subrogation means one party stand in for another. As per the principle, after the insurer, that is the individual, has been compensated for the incurred loss to him on the subject matter that was insured. The right of ownership of the property goes to the insurer, that is the company. Subrogation gives the right to insurance company to claim the amount of loss from the third party responsible for the same. For example, if Mr. A gets injured in a road accident due to reckless driving of third party, the company with which Mr. A took the accidental insurance will compensate the loss occurred to Mr. A and will also sue the third party to recover the money paid as a claim. Number 6, principle of contribution. The contribution principle applies when the insured take more than one insurance policy for the same subject matter. It states the same thing as in the principle of indemnity, that is, the insured cannot make a profit by claiming the loss of one subject matter from different policies or companies. For example, a property worth rupees 5 lakh is insured with company A for rupees 3 lakhs and with company B for rupees 1 lakh. The owner in case of damage to the property for 3 lakhs can claim the full amount from company, but then they cannot claim any amount from company B. Now company A can claim the proportional amount reimburse value from company. Number 7, principle of loss minimization. This principle says that as an owner, it is obligatory on part of the insurance to take necessary steps in minimize the loss to the insured property. The principle does not allow owner to the irresponsible or neglect just because the subject matter is insured. For example, if a fire breaks out in your factory, you should take reasonable steps to put out the fire. You cannot just stand back and allow the fire to burn down the factory because you know that the insurance company will compensate for it. Okay, both are principle of insurance. After that, we are focused on risk and insurance. Definition of risk. A risk that conforms to the norms of specification of the insurance policy in such a way that the criterion for insurance is fulfilled is called insurable risk. Description: there are various essential conditions that need to be fulfilled before acceptable insurability of any risk of any risk. In case of a scenario where the loss is too huge that no insurer will want to pay for it, the risk is said to be uninsurable. Okay? A risk may not be termed as insurable if it is immeasurable, very large, certain, or not definable. Okay? Types of risk. Number first, pure risk. In pure risk, the characteristics of pure risk is that holds out only in the possibility of loss or no loss, and it's very unlikely that measurable benefit will arise from pure risk. It includes such incidents as fire, accident, bankruptcy, and so forth. Speculative risk. Speculative risk is risk that is undertaken because of a conscious choice and has the potential to result in uncertain degree of gain or loss. However, there are three possible outcomes in speculative risk, which are loss, gain, and staying even with neither gain profit or loss. Investing in the stock market is one of the example of speculative risk. Number 3, particular risk. Particular risk is the possibility of loss which can arise from situation related with any specific individual event such as unemployment, robbery, or theft. That is, any losses arising out of robbery, theft will directly affected on individual. Okay. After that, number 4, fundamental risk. Compared to particular risk, the fundamental risk will have a huge impact as it affects a large group of people or companies and can be caused by natural or social events such as natural disaster, government policies, and so forth. Number 5, insurable risk. Insurable risk is a risk that conform to the insurance policy specification in such a way that the criterion for insurance is fulfilled. The characteristics of insurable risk are as follows. Number first, the consequences loss must be accessible, definite, or can be measured in terms of time or money, financially measurable. Second, the prime need for a risk to be insurable is that there must be a sufficiently large number of homogeneous similar exposures unit, law of the large number. Number 3, the risk must be accidental and unintentional. The potential loss of the risk should be unexpected, unforeseeable, and not initially caused by the insured. Number 4, the insured must have an interest in the person or object being insured, that is, they must stand to suffer loss if a loss does occur. Number 5, the insured object should be lawful and not against the public policy or public interest. Number 6, the premium should be economically feasible and the average severity can be readily determined to establish the required premium. Okay, there are risks related to personal or individual activity and business activity, which are: personal risk is the exposure to financial loss or suffering adverse health effects resulting from sicknesses, accident, death. Business risks are loss due to events that may occur during the normal course of business such as bankruptcy, loss, damage caused by various events such as fire, natural disaster, business interruption, lawsuits, and so forth. After learning about risk, we should not be afraid of afraid or worried, because the best and easiest way to manage those risks is to get covered by insurance. Perhaps it is time for us to make insurance a priority in our lives. Okay, let's get insured. Okay, there are five types of risk. Both are references. You are use the references and increase your insurance knowledge. Here is first is my blog link. We are follow the blog and increase insurance notes or material to related this video. Okay, thank you.